Inflows into equity mutual funds surged 42% in June. But on an overall basis, money continues to move out. In fact, it's the biggest drop in net flows since September 2018, and it's largely owing to liquid funds. Let's speak to asset managers about the underlying factors. Radhika Gupta, CEO at Edelweiss Mutual Fund, and Vishal Kapoor, CEO at IDFC AMC. They join us on the phone line. Radhika, I want to start off with you. Which is the bigger headline for you? The fact that equity flows have jumped 42%, or the fact that you are still continuing to see steep net outflows?
I think debt outflows, you mentioned liquid, but I think the non-liquid outflows are actually, in my view, the most concerning part. I think if you look at equity fund flows, they've been in the 5, 6, 7,000 crore range month on month. The number you're referring to is 7,000 crores. Remember, 3,000 odd crores also went out from balanced funds. But even net of that, I think 4,000 crores of equity flows, given the uncertainty of the environment, given the fact that markets still have to pick up, is a good number. The SIP book was at 8,000 crores. So I don't think that's anything to worry about. I think the debt category, if you look at non-liquid funds, lost about 20,000 crores. And that's a big number in my mind. So the fact that because of various credit events and a tough year we've had in debt, you're losing money across debt categories, to me, that's probably the biggest headline in all of this.
Vishal, would you concur?
Yeah, I think I would. But, a couple of additional points, if I can note. I think the bigger headline is that the equity story seems to be on track. And clearly a 40% jump in net equity inflows is significant. And within the categories, again, you'll see that the growth has been broad-based. So it's not in any one product category. So, we've seen significant net inflows across multi-cap, large mid, small, mid-cap, etc. So it's quite broad-based. The second is that a good indicator tends to be the SIP net number as well as the new folio additions. Both of these look quite healthy. So the SIP flows are still 8,100 plus, which is good. And the net new folios added in the industry is again significantly up. So all put together, I think the equity story is still on track. Current market volatility notwithstanding. So I think the long-term nature of that product is seeping through. On the debt side, yes, of course, the net negative seems to be a headline, but I wouldn't worry about it too much. One, I think as Radhika pointed out and you pointed out, it's largely cash fund-led or the liquid category, which is largely, to my mind, a quarter-end phenomenon, which we see, several times in the past. I think this month's number may be adjusted. And, one indicator one should look at is the average assets last month, which was net plus. So I won't look at too much into the month-end numbers for debt.
Vishal, just the follow-up on that, though, Neeraj, morning, the non-liquid category debt side, which has seen outflows as well. And at a time when everybody's talking about how the government and the RBI together are injecting enough liquidity to try and stem the rot, if I can call it a rot, and still seeing outflows, is it a sign of some lack of confidence, even though it may be temporary in nature?
I wouldn't see it that way, Neeraj, to be honest, because, again, I would go by the average assets on debt. Average assets were up. So to that extent, I wouldn't look at just the month-end data and conclude too much into it. Keep in mind that, advanced tax payouts and, generally the quarter-end preference to keep money in cash tends to maybe, tweak this data a bit. So I would look at the July figures more carefully, and I don't see any major impact over there as yet.
So you want to respond to that, and maybe how's the month of July been thus far on the debt front? Part two of my question, Radhika, is we've seen a spate of non-large cap equity funds getting launched as well. Has that category been robust enough? Because everybody is betting on the necessity for that category to do well for investor sentiment to remain upbeat.
In fact, Neeraj, I think the equity story has played out well beyond large caps. With large caps, people have recognized that, indices are at an all-time high. Large cap valuations are relatively high compared to mid and small cap valuations. So if you look at the categories, again to add to what Vishal was saying, that are getting money. You're seeing money come in large and mid-cap funds. You're seeing multi-cap. You're also seeing a decent quantum come into mid and small cap. And mid and small cap was beaten down last year, but the fact that even this month about almost 2,000 crores came into mid and small cap, that's a very healthy sign. It's a sign of a maturing equity market, and it's also very, very necessary. So I think that's an encouraging sign, and even some of the more satellite categories are getting money. So equity is not just a large cap story. In fact, I don't think it is a large cap story. I think it is a mid and small and multi-cap story, and people recognize that that's where the differential is, that's potentially where the opportunity is, and that's where the alpha generation opportunity is. I think coming to debt, a certain amount of money goes out at quarter end for sure in the cash segment, and I think that comes back in the month of July, and you're starting to see that, so that's not worrying. How much money comes into categories like credit risk, etc., maybe that will take some time to recover, my sense. I don't think that's going to recover immediately because I think that's taken some amount of hit post, the debt events of the last 6-7 months.
Well, let's see how it shapes up. I think the month of July would be interesting to see if indeed the equity sentiment has remained upbeat or no, because right now the markets are showing a slightly different story. Let's see if the investors stay put for the long run. Radhika, Vishal, thank you so much, both of you, for joining in early this morning and giving us a small slice of your views.